As you guys know, every day on this channel, I tell you everything Elon said. But today, with the help of AJ, who I'm extremely excited to have on this channel, we're going to dive in a little bit into how and why Elon says things. And we're going to do that by AJ is going to take us through the Q1 earnings numbers, as well as the earnings call, and a little bit on my story. I was an all-in Tesla investor for 5 years. And AJ is the guy who kind of showed me that you don't necessarily need to have FOMO with Tesla right now. And I know a lot of you guys are probably very familiar with that feeling, the dangling carrot that's always in your face. Last year, about 12 months ago, I was one of the early followers of AJ. He's got about 58,000 followers on X. Now he's got but when I started following him, he had about 3,000. And about a year ago, I saw him publish a full earnings deep dive in incredible detail. And he said, next 12 months, my price target is right here. You can see $330 to $360 per share. You can see the date, April 2025. Today, AJ, you can correct me if I'm wrong. I believe Tesla's trading around 370. This is just one of many predictions.
375. Sorry.
375. This is just one of many predictions I have seen AJ nail. He's completely changed my life, along with many other Tesla investors. So he's going to jump into the numbers. AJ, there's not enough words for me to introduce you properly. You're awesome. Take it away.
Thank you very much for having me, Jacob. This is I think, our first video together, and on our track together. I think you were also one of the first people who joined us on the Hardcore channel, which is a new channel. So I appreciate that. So with that out of the way, so let's get right into the numbers. And the way I would like to do it is I would like to let the numbers speak for themselves, and then wherever relevant, we talk about how this might affect outlook, etc. So I thought we start really high level. We just start with total revenue, and we go through a bunch of slides. And just before we get into them, I would like to briefly explain how they work. You have always a graphical representation of the data. Then you have above the data typically always these two rows of percentages. The lower row that is underscored shows you the year-over-year change, and then the top one shows you the quarter-over-quarter. This is typically how one would analyze this data on a very basic level. And then on the far right, you have all this stuff here. This is Tesla's income statement, but it might be a different statement depending on what we are talking about. And the red box every time indicates what is the most relevant item in that list of items that the data that is presented on a slide is referring to. And here on this first slide, we are talking about total revenue of the company. And then, of course, we mark here total revenue. And this is just really to help you navigate through the accounting, through Tesla's financials, because Tesla has a bunch of different segments and cost drivers, etc. And I think this navigator here on the right-hand side can be useful to some people who don't look every day at financials. And then here in the comment section, this gray box, you have then just some, basically what you see in the data is often just documented here. So you have confirmation that what you read is, what you see is correct. And then down here, you have for each year the total and the year-over-year change. So, for example, in the full year 2025, Tesla generated 94.8 billion total revenue, and that was down 3.3% year over year. So this is the way you read it. And just real quick, trailing 12 months is just always the last 4 quarters. That always gives you like a rolling annual perspective, which is also helpful. And then yeah, so with that, let's start looking at the numbers. So first of all, Tesla generated $22.4 billion in this most recent quarter, Q1 2026, that was reported, and the headline number was up 16%, and it was down quarter over quarter, or also called sequentially, 10%, from 24.9 billion in the fourth quarter. So this reduction from Q4 to Q1 is not a problem, because Tesla is still mostly driven by the auto business, and the auto business globally has a slowdown every first quarter every year, unless there are some big shifts in market. But in a normal market, there's always a drop in that first quarter, and so this is not a big deal. And so what you see here first high level, okay, Tesla is nicely growing 16% year over year compared to Q1 2025. And this is how professionals would typically look at the numbers. They don't look typically at the quarter over quarter, they always look at the year over year, because Tesla has a lot of seasonality, which is very normal for basically all businesses. Apple, Meta, Amazon, and yeah, Nvidia not so much, but all these other businesses are just, they all have significant seasonality in their business, and Tesla is not an exception. That's why we talk a lot about the year over year. So just as a starting point. So what you see here, 16% looks good. When you look up here, the year over year changes, this is actually the by far biggest year over year growth numbers all the way since the second quarter of 2023. So you'd be looking at this, you'd say, this looks really great. But the problem is, um, there were a number of one-time benefits, and that is the big problem. And this also explains why, for example, in terms of headline number, like what Tesla reported, Tesla beat significantly analyst estimates. They also beat significantly our estimates, and the share quickly dropped, and this of course might be confusing to some of the listeners. Numbers looked so great, but why did the share price react negatively? And the answer is it's one-off, because stocks do not trade on one-time items, at least not on a sustainable basis, and they quickly adjust for that. And then in the finance world, we call this look through. So analysts look through these one-time items, they adjust for them to see what's really underlying, what's really going on in the business. And here is the first point I need to make. Total revenue adjusted for currency effects was up only 11%. And then the second point I need to make is that the comparison base, Q1 2025, is a very low base, because remember, this was the quarter when Tesla had to shut down its global Model Y production for the transition to the new Model Y. And that, of course, temporarily depressed revenue. And you can see this very clearly. After Q1 2025, there was a very strong uplift. There was a 16% revenue increase quarter over quarter, and so on. And so I just wanted to flag this. So the 16% was not something one should write home about, because it had these two major one-off effects. So the bar was quite low, and on top there was, and I'm not making this up, of course, you can look this up. Tesla said on page 23 of the shareholder deck that there was a $0.9 billion positive impact from FX effects. And just in case you want to know how this works, so Tesla, of course, is a global business, and Tesla holds in all kinds of currencies large amounts of money, and the revenue, for example, in China, of course, is paid in Chinese yuan by Chinese customers, and in Europe, mostly in euro. So when the dollar weakens compared to these currencies, then when then Tesla converts these currencies into US dollar for accounting, then these euros that the Tesla gets, they translate into more dollar, and that effect was quite massive in the Q1, and that was $0.9 billion according to Tesla. So if you eliminate these FX effects, then you can work out quite easily that the year-over-year revenue growth would have been only 11%. That's still very good, still double digit, but not as good as the headline number suggested. So with that, let's move on. Before we get deeper, this is just a long-term observation of the revenue. I know it's a little complicated chart. So the teal color here, that is nicely growing here up until around here, that is total revenue development of Tesla over the trailing 12 months. The nice thing about the trailing 12 months metric is it smoothes out all the seasonality. Is a much better way to looking at revenue trends over time. And the unfortunate thing in Tesla's case is that, since you can see this down here, the trailing 12 months was effectively flat since Q2, Q3 2023, quite stable. You can see this actually remarkably stable. And the ugly point about this is, keep in mind, this is all on nominal terms. Every company that reports number always reports in nominal terms, not real terms. So what does this mean? This is not adjusted for inflation. And as probably everybody knows, we had massive inflation in this period. Prices of everything went up quite a lot. And despite this inflationary effect, the revenue stayed flat in nominal terms, which means in real terms, if you adjusted this revenue for the effects of inflation, it would actually be much lower. So the key takeaway is that actually Tesla became smaller as a company in terms of revenue over the last couple of years, and did not even maintain its size. So that's the unfortunate takeaway from this analysis. And these other lines that you see here, these are just the growth, year-over-year growth rates. You can see at some, and this is, by the way, here on the right axis, you can see that at periods Tesla grew super fast, and then these red lines show you when you saw first year-over-year revenue declines, and then revenue growth has basically come to a halt, where revenue decreases and increases basically set each other off, and that's why for several years now revenue has been flat. So that's just big picture. Then let's move on. Before we get deeper, of course, people might be saying, but AJ, why do you talk about so much about revenue, and later we talk about cars, etc. It's all about AI products. I agree. The Tesla story at over $1 trillion market cap cannot be about cars. I think everybody knows that, because the car business is simply too competitive, too capital intensive, too low margin to justify anything close to 1 trillion. So it cannot be about cars, because if you add up the market cap of pretty much all the other automakers, it's going to be hard to get to even to 1 trillion. So fundamentally, that's not a non-starter. So the story must be about something else to make any sense at all. So that's why we have to talk about AI products. And the closest AI product that we can observe, of course, that is FSD. And a useful metric, how we can assess the progress, is when we look at, okay, how much is it actually being used? And the chart that you see in front of you shows the average miles driven per day in a quarter. And you can see this chart is nicely going up. So there is significant increase in usage. And this metric then basically is like it's just one way we can double click on the progress of Tesla's FSD, which of course we all see on X and on other social media, all these videos, and a lot of people who listen to this might actually even have FSD, and they can test it for themselves. And I think everybody pretty much agrees that the performance is really spectacular. But ultimately, spectacular is unfortunately not good enough, because we're talking about over 1 trillion market cap. It must be good enough to actually generate highly compelling economics to make any sense. That is the crux. And unfortunately, right now, we are not quite at this point. However, we do see in the data that there is a nice adoption. I posted just today about it. The percent of FSD users amongst Tesla's global fleet keeps increasing. And now we jump to the next slide. This is data that Tesla provided for the very first time since the prior earnings call that was held on January 28th this year. And this data is very, very useful, because it shows us how many FSD users Tesla already has, and the number keeps growing quite nicely. And the fact that Tesla started disclosing this data is also helpful and supportive, because it shows us the growing confidence in this product. Because unfortunately, Tesla didn't give us the numbers here for this period, but based on our bottom-up analysis, this would not have looked very impressive, but now we see a very strong trend, and this also lines up with the performance that we can all observe. I think we're all very impressed by what it can do. So this is very good. These are positives, because unfortunately there will be a lot of spoiler negatives later in this video. So I wanted to touch on also the positives, and this is clearly a positive. There was a quite substantial increase quarter over quarter. You can see this up here. These monetized FSD users, which comprise both FSD users who paid upfront, but of course also the subscriptions, increased 16%. So it's a very strong quarter over quarter increase. But I'd like to point out one thing that that you should also mentally adjust for. And that is that Tesla, of course, terminated the option to buy FSD in the roughly in middle of Q1. That means there will have been some, let's call it, run to buy the software by some customers because it's gone now, and so that there might be some acceleration that will basically this number, this growth rate is probably slightly inflated by this termination effect. Just keep this in mind. And then there's another effect which is a little bit ugly. The ugly effect is that once we look at auto gross margin, you have to always keep in mind every single quarter contained FSD purchases. And this nice little margin booster will be gone from now on, because everybody is moving to has to move to subscription. And the thing is, buying FSD upfront is at least in the first few years a lot better financially for Tesla than selling a subscription, because it takes quite a long time before the subscription payment actually matches the full economic value of a large upfront payment, which is effectively all profit to Tesla. And I can't emphasize enough how important it is. So that's the margin outlook on the auto products is right now not that great. I just wanted to pre-position it, but we'll discuss this later in more detail. So now let's move on. Now we dive into the first main revenue bucket. We already talked about top level total revenue. Now we dive into the main segment of Tesla, and then there's of course the auto segment. That segment was up 19%, but of course that segment benefited from also the FX effect that I just mentioned. Tesla did not break out which segment benefited by how much from this currency effect that I already explained. So we can't tell you exactly how much the adjusted year-over-year growth rate would be, but we can look at what was reported, and what was reported implies 19% year-over-year revenue growth. Again, this would be a long-term high, but again, this is based on this very low Q1 2025 comparison base. So this is quite inflated number. And then you also have to keep in mind that Tesla benefited from a significant mix effect because in the first quarter deliveries dropped, but Tesla delivered actually quite a meaningful number of higher margin vehicles. So the Cybertruck S and X in relative terms, because the overall vehicle volume was lower. So these higher margin products had a bigger impact. Just to throw some numbers at you, in Q4 Tesla sold overall a lot more vehicles, but the higher value vehicles were fewer. In Q1, we have the opposite situation. Overall sales were lower, but the higher value vehicles, there were more of them. So, and that's why their contribution had a higher weighting, and that also pulled up not only the revenue, but you will also see later the margin. There was also, unfortunately, let's call it a volume effect that created a benefit. But there is actually things that are much more important, just as a side note. So then let's move on to the key driver of auto revenue. There was, of course, the vehicle sales, and vehicle sales were up 6% year over year. But if you go back, revenue was up 19%. So that shows you, because if you keep everything constant and vehicle sales are up 6%, you would expect revenue to be up 6%. But this is not the case. So there was a massive boost from a better mix. And this is also what Tesla, of course, pointed out on the earnings call, pointed out in the shareholder deck. But I would caution that mix effect cannot last, because number one, Tesla is ending the S and X product line, and currently it looks like that the Cybertruck product is also not experience a massive increase in sales, and therefore this positive mix effect will likely go away in the next quarter. But again, this is just one driver. There are actually more important ones. So let's move on. Now we talk about the average selling price. You can see there was this quite meaningful spike here. Average selling price was up 8%, and this was a very significant driver. But when you look at this time series, I think you can see it on this trend. This 43 is unlikely to Tesla can sustain that, and that 43. Sorry, I should say what it is. This 43.2 is in thousands. So the global average selling price across all vehicles, excluding leasing, I should point out, was $43,200 in the first quarter, and you can see this is substantially higher than it was in any of the quarters since. And you have to go back all the way to again Q2 2023 before you saw a higher average selling price. And a big driver, I believe, is this this end of the FSD purchase option that brought in, by our estimate, about 18,000 incremental FSD purchases. And if you run the numbers in terms of, okay, FSD is 8K, 18,000 more, you end up getting 144 million in basically pure profit. And I think this effect also contributed meaningfully to the increase in average selling price. So you have basically three factors. You have a currency effect. You have the FSD upfront payment, which is reflected in revenue in the automotive segment, driving the average selling price. And you have a better mix effect from the drop in low volume in the first quarter. So you have all these three factors. And unfortunately, the FX effect, we don't know, could stay if dollars stays weak. The second one, the mix effect, is going away basically 99% likely. And then the FSD purchase effect goes away 100% likelihood, because unless Elon changes his mind and says, oh, okay, now you can buy FSD again, but I deem it highly unlikely he would do that. So keep this in mind. So this was also a temporary effect, and you can check on me next quarter whether I was right. If I'm right, you will see this number come down meaningfully. If I was wrong, you see it flat or increasing, obviously. Okay, with that out of the way, let's go to the next one, regulatory credits. So regulatory credits came in 380 million. This was basically exactly in line with our expectation. And why did it decrease so much? I think everybody knows, but maybe I should just repeat it. The largest, technically the largest market for Tesla, the United States, of course, abolished the ZEV credit, so the zero emissions credits trading system in the US effectively, and therefore there's no demand there anymore for these credits that Tesla gets. And in other markets, there is also an increase in electrified vehicles, so there is reducing demand by potential buyers, so other automakers. And the larger American market is gone. And that's why this line will not come back. But this line is quite important, unfortunately, because it's pure profit to Tesla. And an easy way to understand this line is because it's pure profit. If you want to compare it with other revenue lines, I always recommend multiply the numbers that you see here by 5. This gives you an equivalent of a 20% gross margin business line. So if we apply this logic here to these numbers, so this, let's round it up, 400 million in Q1 times 5 would have been a 2 billion profit line, revenue line equivalent. But if you go back just to, let's pick a random one, Q4 2024, so not that long ago, that's rounded up 700 million. Times 5 would have been 3.5 billion. So there would have been a loss of 1.5 billion revenue line effectively from this change in regulatory regime. So that's unfortunate. And then, of course, year over year, this created a meaningful loss. Tesla lost almost 220 million, 120 million in, sorry, 220 million in basically pure profit year over year. So there was a clear headwind, and this line item will not come back. Then let's move on to the second largest segment, or second most important segment. That is, of course, the energy generation and storage segment. Here, revenue was down 12% and was down 37% quarter over quarter to $2.4 billion. And if you look, this is basically in line with Q3 2024. I'd argue that most people did not expect such a pullback. This is a very controversial topic also, because a lot of people do not like the idea that there's a competition in this sector. And unfortunately, we spend a lot of time on this, in this sector, in this industry, and globally, there's a very significant competition is growing. And what we found is that in many cases, competition undercuts Tesla by 50%. So then, of course, there's the argument that Tesla has the auto bidder software, etc. But this is also an area where a competition is growing. So, and if you listen very carefully to the CFO, and when he speaks about the guidance or the outlook for this segment, his tone, I highly recommend everyone who listens to this, just go back, pull the transcripts for the last 4 or 5 calls and listen to the CFO whenever he talks about the energy storage business, how confident he sounds. And I can tell you, his confidence level has come down quite substantially. And in the most recent call, so this week, he pointed out that he expects margin compression, and he pointed to the competition. And when he talked about the outlook, and he was he is still bullish, don't get me wrong, and that's why we still forecast in our modeling significant growth in this business, but it's not quite what it was like only 12 months ago. So you should expect you should still expect growth in this business, but not at the rates that we kind of grew used to. So let's maybe look at these storage deployments. So now we look at gigawatt hours, and you can see in the first quarter this dropped to 8.8, and while in the prior quarter it was 14.2 gigawatts. So there was a massive drop, 38% drop in storage, and you can see the this was broadly in line with the revenue, 37%. So the one positive in these numbers was that the pricing held constant, basically. But here's an ugly point, and we'll get to it later. There were also one-off effects included, and here I have to speculate, unfortunately, a little bit, which of course opens me up to a lot of criticism. It's about the Megapack 3 product. A lot of people will say, "Oh, AJ, you're missing. Tesla is moving to the Megapack 3 product. That's why they had here this temporary loss." Then also informed people will point out, "Oh, there is also seasonality in this type of business, because in some regions there's winter, yada yada yada, all these things." Unfortunately, even though these points are all valid on their own, our research suggests that Tesla's move to Megapack 3 was because it fell. I don't want to say it fell behind, but competitors introduced products that were really good. And so the Megapack 3 product was not just running away with innovation. The transition to the Megapack 3 product was actually necessary to defend the market position. It's like in cars, the Model Y, great car. I have a Model Y Performance as a daily driver. Great car, love it. But you know, it's before the refresh, Tesla had to do something because others were just getting too close to comfort to the Model Y in terms of overall offering quality, and so they had to refresh it. And in this commercial product, the Megapack product, it's of course it's not about how it rides, how it looks. No, it has to deliver on certain key performance metrics, and the economics have to be right. And Tesla was forced to upgrade to the Megapack 3 product, and that's why we have this volatility in the business. However, in our outlook, we still expect significant growth, but just keep this in mind. You should kind of revise your expectation, and because down here you see how quickly this business grew in 2025, 49%. I highly recommend, when you consider this business, do not assume anywhere near this growth number in 2026. It will be a lot lower, I can tell you. And again, you can check on me a couple quarters later whether I was right, but we're not going to be anywhere close to these growth numbers. And I think Tesla also already gave a clue in the shareholder deck for people who looked closely. I recommend go to the section in the shareholder deck where Tesla discloses all the capacity globally, not only for auto production, but also for energy storage products. And what you will see is there was a revision downwards in the production capacity. And I think this already gave you some clue what's going to happen. Again, I don't think disaster, but just set your expectations a little lower. So with that, let's move on. The next one is the implied average revenue received by Tesla for each kilowatt deployed. This is a little bit a complicated metric, but a very important one to study. So first of all, on average, for every kilowatt deployed, and this not only comprises the large commercial Megapack product, but also the home storage product for individuals at home, and so everything included. And I have to point out the latter, the home product, has a much higher margin than the large commercial storage product. But in normal quarters, when Tesla has very large deployments, like you can see this here in Q4 2025, when Tesla deployed all-time high 14.2 gigawatts, the share of the lower margin commercial product will be much higher, of course. But then but it's much more volatile, and then the home product. So when total deployments drop, it's driven by the commercial product, not the home product. And then when overall volume is low, the home product with higher margin has a higher contribution. And that means that even though the pricing was basically flat, it was up 1% quarter over quarter. In essence, if you think about this volume effect that I just explained, on an apples to apples basis, the average price obtained would have been actually lower than what you see in this pure headline number. So that was one effect, but there is one that is actually much more important. And for that, I wanted to jump real quick. So I will skip real quick temporarily service another, and I will skip this because it's a very important point. So I skip a couple of things. We come back to them later. I want to talk about cost real quick. And here we are. So now I jump to the gross margin of the energy generation and storage segment. And what you see here is like crazy. The margin came in at 39.5%. You would say, oh my God, that's amazing. This is like super lucrative. This would almost be at Ferrari level margins on a battery product. So 39.5% is crazy. You might be thinking, oh, this must be typo. No, this is in line with the reported numbers. So what happened? So what happened is Tesla booked very large tariffs related reimbursement. So in essence, some of the tariff charges Tesla transferred to the government were paid back. And this had this was let's call it a paradoxic windfall for Tesla. So what happened first was Tesla had to charge customers higher to compensate for these tariffs. And Tesla told us actually on an earnings call that some customers basically took the hit. And so Tesla charged them higher to compensate for the tariffs. So Tesla took in more money. Then Tesla transferred that money to the government. And then fast forward, Tesla now receives a reimbursement for these tariffs. So basically Tesla was able to charge customers higher, collected the money, and now gets the money back from the government. So there's this massive one-time effect. in the numbers. And so it's a complete fluke, effectively. And when you adjust for these effects, and management talked about it, so the CFO told us that this effect has a more than, I quote, and here's the quote in the margin, recognitions of more than 250 million from certain tariffs. In our modeling, we assume, as a working assumption, 270 million. If you adjust for that, you will find that the margin actually decreased sequentially. So it's not 39.5, it's probably closer to somewhere in the 27% range. That's probably what a real margin was. But again, keep in mind, that's just the margin effect. But then you have this volume effect that I explained with the higher margin home product. If you account for that, if Tesla had sold significant volume this quarter, the actual margin would probably be already below 26%. So there was again a negative trend that looked on paper as like a really strong trend, but underlying it looked actually a little challenging. I pause here for a second, Jacob, to maybe give you maybe a second to react to what I've been talking about so far, if you want, or I just keep going.
No, I was just running over to grab my notes because I wanted to start writing some of these stuff down so I could summarize it at the end, because that was a huge point that I wanted to write down. But my new remarkable tablet is dead. But maybe I'll pause to give you a voice break. You can take a glass of water, and I'll just say to the audience, like, you guys see the level of detail, and imagine, you're getting this level of detail on a big bucket of companies. I'll just wanted to give AJ a break there. Um, and we'll get to what AJ offers at the end, but I hope you guys are enjoying it. And I know it's probably not easy to focus on such high frequency digits for an hour and a half, but I promise you it'll be worth it. So stick with us.
Yeah. So I can. So if you're an investor, just big picture philosophically, if what you do on social media is all enjoyable and takes no effort, I can tell you, you're either an extreme outlier or you do something wrong. If you do really hardcore investment research and you want to get ahead, it is painful to some degree, and but I think it's well worth, if you have a little bit of capital to invest. And the way I usually try to explain it is, if you think about it, let's say, by investing, let's say, 10 hours a week into investing in general, and let's say per month that's 40 hours, but per month I'm making up a random number. You have a small portfolio, you make, I don't know, 4,000 extra. So then you can divide the 4,000 by the 40 hours you invested. Then you would have received $100 per each hour invested. So that's, for probably a lot of people, a pretty good hourly salary. And this is how I would recommend people think about doing investment research, because then you quickly realize, oh, it's actually worth a lot of money to invest time into this topic. Yeah. Anyways, so let's get back to the topic. So this was the energy storage and energy generation and storage segment. But I skipped now over a lot of important points, so I go back to where we left off before. So we talked about the average kilowatt price of the battery product. And next we look to the third segment that Tesla currently discloses, and right now there are only 3 segments. I expect in the future Tesla will disclose more segments, but it's a topic for a different video. So the services and other segment, just to recap real quick what this includes. So this, of course, includes all the used car sales. So when Tesla gets a returner, they sell, so they make the vehicle nice and sell it on as a used vehicle. They make margin on that. That is an important part of the business. Of course, all the not under warranty service and all these things, all these charges is included in segments. All the paid supercharging sessions is included. Tesla insurance is included, and also the current robotaxi ride-hailing network revenue is also included in this revenue. So there's a bunch of stuff here included, and also all the merchandise and all other things is included in this segment. And that segment is a very positive, consistent grower for the business. So headline, you can see this here. Just look at these year-over-year growth numbers. They're quite significant. First of all, there has never been a year-over-year decline, first observation. And second observation, when you look at these numbers, the smallest number that you can see up here is 15%. That was the slowest on a year-over-year basis this part of the business ever grew. So this is by far Tesla's most consistent driver, and it should not be a surprise, because this business mostly grows with fleet size, and Tesla's average fleet age is still very young. So despite car sales stagnating, the fleet keeps growing quite substantially, and that is just a very consistent driver in this part of the business, and that's why the business was up quite substantially, 42% year over year, and was up 11% quarter over quarter. So there was a definitely a bright spot in the earnings print. Unfortunately, that business is not very high margin, and that's why in terms of earnings, it's not a massive needle mover. That's the only downside, but it's a nice revenue driver. Now this slide is just a summary, how you go from the Q1 2025 total revenue of 19.3 billion to the total revenue of Q1 2026 of 22.4 billion. It shows you how much each added, each meaning each segment, and you can see that the auto business was by far the biggest driver, added year over year $2.5 billion, and the second largest driver was the services and other segment, added $1.1 billion, while regulatory credits, I broke this out as a separate segment because it doesn't relate to the economics really, to the car business, etc. That came down as we looked at. Then also the energy generation and storage segment also came down a little bit, 320 million year over year. So that's the bridge. The quarter over quarter is this. So this is the bridge from Q4 to Q1. That is not that important in my view, because again, there's significant seasonality, but just for completeness sake, so quarter over quarter, what was causing the 10% drop in revenue? One, it was the energy and storage business, because there was much fewer deployments. There were loss of 1.4 billion, but of course that came from an all-time high deployment quarter, keep that in mind, and so this looks a little worse than it might be under the hood. And then the auto business came down 1.3 billion, but of course that was driven by a substantial reduction in volume and lower average selling price. Okay, with that we left the revenue discussion, and now we move on to the cost side of things. And now so this first chart, we look at the average vehicle production cost, and you see here on the slide, oh, this went actually up. So average vehicle production cost was 35,200 in the first quarter. That was up 4% year over year and was up 6% quarter over quarter. And now people who listen to the earnings call might be thinking, oh, this can't be right. Tesla told us, and it's also written down in the shareholder deck, that vehicle production cost decreased year over year. So Adrian must have made a mistake. I wish I had, but the problem is what you see here includes what's reported. And what Tesla did not break out in the numbers is what they did cover verbally. And Tesla told us that the auto segment benefited also from these tariff reimbursement. If you remember just a minute ago, we talked in the energy storage segment about how the margin was super high, almost 40%, almost like Ferrari-like, because there was all these one-off effects lowering the cost in the energy generation and storage segment. And the same thing happened in in auto. In auto, Tesla also got these tariff reimbursements, and these reimbursements did not increase the revenue. They lowered the production cost. But what Tesla did is they did not break. I explain later in a better way. It becomes more clear, but just bear with me. In the reported numbers, you can't see this effect, and therefore you have the implied growth of the cost. But later in the presentation, I will show exactly what I mean. And the Tesla, actually, why don't we talk about it right now? I have to just jump very far to the end. Okay, this is a very, very important slide. So this is slide 23 in the shareholder deck, and this is something Tesla provides every single time. And this slide is very, very useful, and it actually delivers a lot more than I think a lot of people realize. And first of all, in finance, the gold standard, what big companies always adhere to, is they order things in importance. So top to bottom, you always list the most important thing first, and then second, third, and so on. So keep this in mind. So these lists are not random. These lists are ordered by importance. And when we look at where is it? Here is a plus point. So Tesla says lower average cost per vehicle due to lower material cost. But as you just saw, the cost went up, implied by the numbers. And the reason is you have here, where is it? Here, the top one. The top one says increase in automotive one-time benefits related to warranty and tariffs. So because the implied numbers are higher, but Tesla says vehicle cost came down. So the offsetting factor must be the benefit Tesla received here from this one-time item. And this one-time item comprises two elements. One is the warranty effect, and one is the tariffs effect. The tariffs effect is what we already discussed. Tesla received this money. That lower production cost, of course, was clearly a one-off. Tesla, of course, when they talk about underlying production costs down here, they're not including tariffs. It would be silly. They just strip out these effects and look at, okay, how much did it cost to make a vehicle? X amount this quarter, and how much did it cost last year? Y amount, X is lower than Y. Okay, we reduced cost. What was the driver? They tell us lower material cost. So they of course take out these items when they talk about it. And so the bottom line is the warranty. That's something we have not yet talked about, and this was quite a substantial item. The CFO talked about it. Tesla did not disclose it anywhere, so you have to go into the transcript to find it. The CFO said there was he called it a true down of the warranty reserve, and we covered this. I forgot where in the slides, but it doesn't matter. Let's just stay on Tesla's slide. So this warranty, I just would like to briefly explain how this works. So every time Tesla sells a car, they set aside some of that money they received to pay later any claims that might emerge. And in Tesla's case, Tesla sets aside roughly $2,500 per vehicle. So that's factored into the cost. And what you can observe, and unfortunately I didn't have time to include that slide, Tesla has been increasing, Tesla has not only been adding new reserves to the existing reserves that come from new vehicle sales. Tesla has also been adding for several quarters in a row additional reserves to prior vehicle sales. That means the prior vehicle reserve was not enough. So Tesla kept increasing, added several $100 million per quarter and for several quarters running. And this quarter was now the first quarter in a while where the opposite happened. Instead of increasing the reserve for existing vehicle fleet, Tesla did release a significant amount, and that also boosted the margin in the auto business. And now let's get back into the materials to look at how much that was. Let me just really quick find it. Okay, here's the auto gross margin as reported. So that came in at 21.1%, and that would be a really good. I mean, it would be, by automotive standards globally, that would be considered a pretty good gross margin, not stellar, not like luxury car like Porsche or whatever, or not anywhere close to Ferrari, of course. But it's Ferrari. Ferrari is not an automaker, by the way. Ferrari is a luxury goods maker. So, but just give you some ballpark numbers. Once you get to 22, 23, 24, that's really, really good in the auto industry, gross margin on an apples to apples basis. 21 is already quite good. Most automakers would kill to consistently deliver 21%. Once you get below 20%, it gets a little tricky. And once you get to 15 or below, you're in trouble in the auto industry. So just ballpark to give you some benchmark to how to look at these numbers. So 21 is a really solid number in my view. And then when you look at this trend, you have to go back all the way to Q1 2023 to have a similarly high, actually exactly the same margin. And now let's look at, okay, what was actually driving that? And let me see, okay, here, so that's the relevant chart. So when you actually, let's look at this first, because I want to create an apples to apples basis. So this auto gross margin is not the total auto gross margin we just looked at, 21.1. This one excludes regulatory credits. This is a better way of looking at the auto business, because it gives you a purer view of what the auto business generates. And that margin was also very good. That margin came in at 19.2%. And same story. And here you have to even go back even further. You have to go back to Q4 2022 to find a bigger margin. And so this was quite good, quite solid. But here's the problem. There were a bunch of one-off effects baked into this number. And now we talk about this chart. This chart is showing you the exact same number. I just flip back and forth so you can see the difference. And the key difference is that we adjusted the most recent quarter, Q1 2026. So what we did is we accounted for the warranties. So the way you have to think about it, the warranties set off your cost, and that then increases your gross margin. So if you strip those out, those were 230 million. It's quite a large amount. And then if you strip out reimbursement, and at the time when we did this analysis, our analysis implied 108 million. Meantime, we had more time to investigate this. We believe this is actually more than 108 million. But I will cover this once we are done with our complete outlook update. But the bottom line is that already depressed the margin to 17.1%. It's probably even slightly lower than that, not a ton, but slightly lower than that. But here's the other effect, which we have not yet included, because you can have a debate whether it's an apples to apples. But remember, the FSD purchase option is gone. And that was a nice recurring margin booster. And in the first quarter, we had this additional effect that probably people who may have bought FSD maybe in Q2 or Q3 of this year, that some people will have said, oh, I just buy now FSD before it's gone for purchase. And so you have these one-off effects, and they're actually quite material. And I think I mentioned this in the beginning. We estimate that these incremental sales, they probably had 144 million impact. So basically, if you add all these elements together, the margin was probably much closer to 16%, possibly even in the 15% range. And then when you look back, this is basically in line where we were at the Q2 and Q3 of last year. So and there was another kind of a disappointment that while we looked at this nice headline number of 90.2%, once you strip out the things that will not recur, then you realize, it's actually not that great. Okay, I think we covered, spent enough time on that one. So let's move on. So there's the auto business. We talked already about the energy generation and storage, so we skipped that. Here, a slide we
Hey,
haven't talked. Yeah.
AJ, if I can interrupt for a sec, do you want me to tell a quick story to give you a break about your alert to subscribers right after Tesla printed these numbers?
Yeah, if you want to talk about it, go ahead.
If you want to go back to that slide from the shareholder deck, AJ had us position into Tesla stock a few days ahead of the earnings call, and the reason was Q1 24. Elon flipped the script and he said we're going to come up with a low cost vehicle, and that sent the stock on a run. Q1 25, he flipped the script again by saying that he was leaving Doge, and in Q1 of both of those years, Tesla was depressed, and so AJ predicted he was going to do the same thing in Q1 26. So we all bought a little position. I can't. Oh, there you go. If I remove you. He alerted us in the hardcore channel, as you see here. But when the numbers came out, AJ knows Tesla's balance sheet so well that, as you guys saw how he's adjusting these numbers based on those one-time offs, AJ, within maybe 2 minutes of those numbers coming out, it was a 24% EPS beat. And so the stock went up 4% right away. Instead of waiting for Elon to get on stage to flip the script, AJ alerted us saying these numbers are one-offs. These are not recurring numbers. And so we all sold at a 4% gain. And once everybody had digested them, because they were slower than AJ, the stock dropped 8% from that 4% gain the next day. And so that's how well AJ knows these numbers. So I hope you had a break there, AJ, and I'll let you continue.
Yeah, on that one, the thing is, the reason why I know these numbers is I've been modeling Tesla since the prospectus was out, and that was in early summer 2010. So I've been modeling the company at this point for 16 years, every single quarter. And so basically Tesla's numbers are basically burned into my retina. And and then on top of that, I have a problem. I have an eidetic memory. I look at things and I struggle to forget them when it comes to financials. So when I look at Tesla's shareholder deck, I literally just flip through the slides and I can instantly pick up which numbers are off and which are good, which are bad. So it takes me actually not 2 minutes, it takes me at most 30 seconds to see, okay, this is a good, bad, neutral print. But then, of course, I have to write the post and send it out. And then, of course, I add I flip a second time just to make sure I'm not missing something. And that's why it takes 2 minutes in total to process. And we tested actually different AI systems, latest version of Claude, OpenAI's product. Grok also, and we tested how quickly they can capture different earnings releases, not only Tesla's but also earnings releases of other companies, because all of them have different formats. And we found that AI systems, even if you buy like the one with all the bells and whistles that are quite expensive, they take a lot more time than a human that studied, or a human that preloaded all the numbers in the mind, basically studied all and knows the numbers. You can much more quickly, with some experience, assess, okay, this is good, bad, neutral. And the AI system takes a lot longer. I know firsthand, because I know relevant people. People have been building algorithms long before we had the name AI for what we use today, systems that try to decipher really quickly on a deterministic basis earnings releases. And people who know about these things, they know that, for example, hedge funds pay incredible amounts of money to be able to rent places that are close to the stock exchange server, because this physical proximity of their server to the stock exchange server gives them a few milliseconds of speed advantage. And so they spend a huge amount of money on these things and on these systems to read earnings prints very, very quickly, so they can front run the markets by milliseconds. So there's a huge infrastructure globally around just earnings releases on this point. But as a human who studies numbers very well, you cannot respond as quickly as them. Of course you can, but you can get quite close, especially when it doesn't come down to the numbers, but reading between the lines. And Tesla's earnings print in Q1 was a perfect example, because literally all the headline numbers signaled beat, beat, beat. That wherever you looked, revenue margins, EPS adjusted, all looked amazing, massive beat, and these things can throw off these systems, and they're not that advanced yet, somehow, and then the AI system that can actually understand them better takes too long. Okay, so I think I went too long here on a tangent anyway. But all I'm trying to tell you is, if you study a company well, there is still some alpha to be had, if you know what you're doing. Anyway, so shall we carry on in the presentation, or you want to discuss the setup for the Tesla trading?
I don't know what you had planned, but maybe I'll say that the importance of going through the presentation in detail is all these numbers are baked into AJ's forecast and corridor. And I know your adjusted forecast based off the Q1 delays is not ready yet, but I just wanted to say there is a reason that we go through this in such detail. It's all baked into your corridor
Yeah.
method, which we haven't shown to them yet. But yeah, I'll just say that if you'd like to keep going.
Yeah, no, it's a very important point, because the thing is, I'm so deep in this stuff that I often just skip points, because they're so second nature to me at this point. But so it's good that you touch on these. Yeah, so basically we have a very quantitative approach. My background is not only finance, but also math and physics. So I like to approach things from a mathematical with a mathematical framework. And actually, when we do forecasts, we try to inject as little as possible of ourselves, and we try to let the numbers speak for themselves, and that flows through all of our forecasting. And that is the reason why we tend, in most cases, we tend to beat Wall Street. Our forecasts tend to be almost all the time more accurate. And I recently explained this on the Hardcore channel. What maybe not everybody realizes is that predicting exactly or very close the EPS that is reported is actually not the point. And the Tesla Q1 result is a perfect example. So Tesla reported 41 cents. And the consensus of the average of all the Wall Street analysts that report forecast for Tesla, quite a few of them, and the average of them, that was 33. And that is this widely reported number that you see everywhere in the media, etc. And also what investors talk about, people with large funds, so people you think they know what they're talking about. But here's the problem. Let's say you have an analyst who actually predicted 41 or 39 or 42, who was really close to the number. You would be thinking, oh, this analyst is really great. Consensus was only at 33 cents, and this guy was very close to 39. But here's the crux. And we always talk about adjusted numbers, just to be very clear. We're not talking about GAAP numbers, because they are not that relevant for stocks in most cases. So on an adjusted basis, you want to take out one-off effects. So that's the starting point. And the reason why you want to do it is because the stock doesn't respond to one-off effects. And the Tesla Q1 was the perfect example. If the stock would respond to one-off effects, the 41 cents, that the stock should have been flying, because it was a massive beat, and the stock should have been up probably 6, 7, 8%, and then gone up higher the next day. But because it was all one-offs, it deflated. That was the reality. So what you don't want the analyst who actually nails the headline adjusted number. You want the analyst who predicts most closely to the underlying number once you strip out all these one-offs. That is the crux. So as an analyst, you do not, yes, let's say You have an amazing analyst who knew about all these tariff reimbursements, which to be honest with you, we didn't know about. The Tesla would book them in this quarter, so we did not include them. We did not even talk about them. Um, but even if we had known about them, we should not have included them in the forecast, because that would have been a red herring. That would have inflated our earnings, and that would have depressed the implied multiple, and all the downstream analysis would have been less accurate. So what you want always be looking for the analyst to predict the underlying earnings most accurately. So okay, so this was just a little side note. I just want to make this clear, because in my investor conversations, and I talk to investors basically daily. Not basically, I do talk to them every day, and this is often not clear, and then they get confused. Oh, Tesla beat. So I hope your audience gets this very basic fundamental point about beats and misses, because sometimes it can be very confusing. You have a company that beats like Tesla and the stock is down, and then you have a company that misses and the stock is up a lot, and you think to yourself, okay, what the heck is going on? And then you always need to look at, okay, what was driving these misses? Is it one-offs? Is it a non-recurring item? Then it's not a needle mover, and who cares? And this will in most cases explain the share price reaction. And the other one that explains a share price reaction that is often not visible in the numbers, sometimes you might have like a great print underlying and the stock sells off. Then what you should do is you should be looking at, okay, what was said in the call, and what you will find is that there was something in the call management said that investors didn't like. For example, the Amazon earnings call was a perfect example. Amazon delivered great set of numbers. Everything looked good. Stock did well, but then management dropped the bomb. They expect 200 billion in capex, and then boom, we had a massive sell-off in Amazon. So anyway, I'm just sharing these, let's call it anecdotes, to make you more sensitive to how these things work. And the numbers is just one dimension, but there are several other dimensions you should worry about. Jake, is there anything else, or should I carry on?
Yeah, let's as long as I know we're already at an hour, but if you have time, I'm happy to carry on.
Oh my, yeah, I don't want to don't want to force your audience to sit through like several
My
hours of
audience
video. Uh,
my audience needs to see this because as we get deeper into it and we get into the capex and into the delays, my audience is only exposed to the hyping of Elon on X. So it's important that we get through this. The only reason I brought up the fact that it was an hour was because I don't want to take too long for you, but I'm happy here.
it's fine for me. I'm always happy if I'm able to reach different audience, because of course what I do, the way we post, we don't have the greatest exposure. It's always good if people see something like this. So basically, what you're looking at is like this is like top level Wall Street research that typically only institutional investors get to see, high net worth individuals. The reason why I know is because I was an advisor to these client groups, and so I built for basically decades for this very small set of people this type of analysis for a long time. And I always felt like it's very unfortunate that average Joe will never have access to this type of research. And this explains in big parts why already wealthy clients become more easily even more wealthy, because they simply have access to much better research than, for example, what I see on X and other social media. Okay, I will speed up a little bit to make it less, because there's a lot more materials we should talk about. We talked about these things. Let me just flip through. Okay, the next big one we should talk about is operating expenses, because this also tells us a lot about what's going on in the business. So operating expenses, let's just briefly touch on what it is. So operating expenses is, you can briefly say, it's your overhead cost. So this is cost that is not really linked to your volume, how many cars you sell, how much battery storage you sell. No, this is kind of less dependent on that, and there's some things that are linked, but let's not go into the minutia. Big picture is your overhead. And in Tesla, there are two, or in every company, there are two big buckets. There's research and development, and there is selling, general, and administrative expenses. And then in Tesla, sometimes there's restructuring charges or other charges. This is not the case in Q1. So Q1 was a pure R&D and SG&A quarter in terms of OPEX. OPEX is short for operating expenses. And when you look at these numbers, you see very high growth rates. So let's just look down here at the year-over-year numbers. So in 2023, Tesla grew OPEX by 22%. From 7.2 to 8.8. Then the year after, it grew it by 18% to 10.4%. And last year, 2025, it grew by 23% to 12.7%. But remember, in the beginning of the presentation, we talked about how Tesla's total revenue was actually flat for the last couple of years. So in essence, what happened is Tesla became actually a lot less efficient. And when you define efficiency in terms of overhead or operating expenses divided by total revenue, that ratio kept going up. So and that is a measure of becoming less efficient, or is basically the opposite of economies of scale. As a business grows, you would expect that operating expenses, so this is like traditional economics or finance, that spending in relative terms goes down. This is not observable in Tesla. Tesla business basically was flat, but spending kept growing up. And so what was driving that? So let's look, I have to jump a bit. So here, let's look at the first big item. So this is R&D spend. So Tesla spent 1.9 billion in R&D, and that is yet again a new record. Last quarter was a new all-time high. The prior quarter was a new all-time high. Bam, bam, bam. You can go back all the way to Q3. You have to go back all the way to Q3 2024 before you did not have every time a new all-time high. So something happened. And keep in mind, the revenue was not increasing, but Elon kept, and this is all up to Elon, let's be very clear about this, but Elon kept massively pumping R&D. And I got a lot of hate for that on X when I said this for the first time. It's not a sign of confidence. It's not a sign of strength if a company that is not growing revenue increases R&D spend significantly and spends an ever higher ratio of its revenue on R&D. This is a hallmark of a company that is driven by competition. And I know 100% now. A lot of people, we just lost a lot of people in the audience probably, but this is just the factual reality. If Tesla felt very comfortable in its position, they would not be spending this much. And a lot of people might be thinking right now, yeah, but AJ, it's bullshit, because this is simply because Tesla is working on so many projects. Well, Tesla has been working on this project for a number of years. They even cut certain projects like Dojo. Now seems like it's been reinstated. But anyways, you can't just keep raising R&D like to the ceiling if you're not growing. And the effects of that we'll see in a moment, which are quite severe. But the bottom line is, this is not exuding confidence. That's, I think, crystal clear. And the problem is, when we think about the different products that consume a lot of R&D, Tesla clearly has not heavily invested in cars, because let's be brutally honest, the Q1 2025 Model Y refresh was not an upgraded platform. It was just a refresh. They changed the body a little bit. They fixed a little bit the suspension, a couple of other things. Of course, I'm simplifying. They made a lot of changes, but fundamentally, nobody would say this was a new car. So there was not a ton of investment in the platform, and the same is true for the Model Y, unfortunately. So where did the money go? Of course, Tesla is pumping the pedal on FSD, pumping enormous amounts of money into FSD, hiring talent. Compute, of course, is consuming a lot of resources, etc. And by the way, this R&D spend does not reflect the investment in data centers in Tesla's large compute clusters. That's a separate thing. What's included here is only the depreciation, so not these multi-billion-dollar investments. That's a different thing. And so the bottom line is, so Elon is really going very hard on R&D on all fronts, because I think he knows there's a ton of competition. For example, our research suggests that in China, China is very far ahead with humanoids, not only in humanoids' body. They're like they have. We found there are over 30 credible humanoids makers in China. Most of them are not public, so you don't hear too much about them yet. And there are like 10 that look really advanced, and then there's a whole host of other humanoids makers who focus only on the brain, on the software. And what they've come up with is very impressive, where you can really just talk to it, and it can, with large language models running in the background, understand. So there's a lot of stuff coming down the pipe. So and they are really quick. And then on top of that, China is already massively ahead in terms of manufacturing. They're already making thousands of units per quarter. And one thing we found in our research is also clear: the one who starts manufacturing the first in a new product category usually has outsized advantages. But it's a too deep a rabbit hole we can't get into. But the bottom line is, do not bet on Tesla being the vast leader in humanoids in terms of the best humanoid brain capability body. This is a very stiff competition, and I would also like to caution everyone who base their view of Tesla on how they defeated traditional automakers. I won't talk too long about it. I will just say that competing against these automakers, there was a completely different crowd than the current competition. The current competition is highly innovative, aggressive startups, some very highly funded startups who can poach also key talent, just like Tesla did in its early days. And then, of course, this is not only humanoids. The other important product is FSD. In our research, but there's not a ton of data we can work with. Our best estimate is that the second strongest competitor might be only 18 months, so it's 1.5 years behind Tesla's current capability. So if we are right, we will be seeing towards the end of 2000, what is this, 2027, so end of next year. If we are right, we will be seeing competitors in FSD that will deliver something that is as capable what you see today. But of course, the argument is that, well, in 18 months, Tesla system will be so much better. Yes, it will be. But the problem is, when you think about FSD in terms of performance curve, and you think like performance is on the y-axis, so the vertical axis, and 0 is at the bottom, and at the top you have 100. So Tesla is asymptotically approaching the 100. It's almost perfect. It's like 99.9% perfect. This is what Elon was always talking about. It's the march of nines. In the way you can think about it is, Tesla might be, I'm just making up numbers, might be at 99.99 perfection, let's call it. And the current competitor might be at just 98. But in 18 months, if we are correct, the competitors will be at 99.9, and Tesla might have unlocked another 99.999. And at this point, Tesla will still be a lot better. But the problem is, the competition will be already so good that it becomes hard to distinguish. Tesla might be able to scale massively FSD with the still better performance, but for the end consumer, the real utility might be hard to distinguish. And then it comes down to just robotaxis, because in a large scale robotaxi, you need really these almost perfect systems, and then 9.99 might not be enough. And this is where Tesla still has the advantage. But we recommend, do not bet that in the auto business, Tesla can can generate a sustainable advantage. And now the argument would be, but AJ, even if you're right, even if someone makes in 18 months a software that is so close that for the customer it's hard to distinguish, but they still need to put it into the cars. That's true. But now we have to go back to the investor perspective, because market is always forward looking. If in 18 months someone shows up, if we are right, that produces something really strong, then the market starts to price in these things and will say, oh, well, it looks like it's being commoditized. And the fact that maybe the competitor can't put it yet in a product, in a car, is actually not that relevant. So anyways, I think I went again on a very long tangent here. So just the point is, R&D expense is going through the roof, and that has significant ramifications in terms of profitability. Now I jump back to operating profit. So operating profit accounts for all these operating expense increases, and operating profit came in at 941 million, even though, and this is another unfortunate negative, we talked about all these one-off effects, tariff reimbursements in energy and auto, and warranty releases, blah, 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 all this stuff. Our current analysis implies, if you add everything up without double counting anything, there may have been a positive effect of close to 1 billion. That means if you clean everything up, Tesla got really, really lucky in Q1 2026, and without all these one-offs, this may have been actually a loss-making quarter for several years. If you just look at his time series, Tesla hasn't been loss-making on an operating profit basis for several years. And I think this is a stark realization. And you can see last year already, 399 million. And keep in mind, this company trades at over $1 trillion market cap. So it's not like, you know, and I made this example when I discussed this on the hardcore channel. For example, NVIDIA. NVIDIA is worth about 3 times as much as Tesla right now, market cap. So a lot more. But the problem is NVIDIA makes over 31 times more profit. That is the crux. And that's why Tesla's forward multiple is just outrageous. By our estimates, far above 200 right now. And NVIDIA's is currently, after the recent surge, still just 21, at most 22 times forward earnings. So when you compare Tesla with other really great companies, but of course NVIDIA is a very high bar because it's basically the stock market king right now. And but you know, Tesla is also, you know, Elon says Tesla will be the most valuable company in the future, worth more than most 5 most valuable companies combined. For that reason, I need to bring in the champs right now. And when I compare Tesla with the champs that Elon wants to beat, there's just this huge gulf. And I think this is also part of the reason why in Elon's compensation package, there were all these big market cap milestones. But what was very peculiar was that the earnings milestones, they were actually quite low. Because when you look at the market cap milestone and what was needed in terms of EBITDA, that would imply a massive multiple. So Elon's compensation package reflected that the market would still give him a huge premium because it's run by him. So, but again, we are long past Elon's compensation package. So I think not really worth to regurgitate these old things, but it just shows you that the valuation is just quite insane. I've never seen anything like it. But in our forecasting, we account for this sentiment, as we like to refer to it, because in our investing philosophy, every company trades on its own sentiment, and the classical approach that apply to investors, for example, classical Wall Street approach is they use what's called comps. Comps is where you take a bunch of companies, you calculate their implied forward multiples, and then you look how they trade on average, median, and so on. And then you look, okay, who is below, who is above, to see which company is possibly expensive or inexpensive. In our investing approach, we found that these traditional Wall Street methodologies they don't provide good results. So that's why we always assess the sentiment. And I said this many times before. Yes, Tesla is super expensive, over 200 times forward earnings on optimistic outlook, but the bottom line is it might still keep this multiple for many years. Who knows? And it's conceivable that if the setup is right, it could even go to 300, because not too long ago Tesla traded already at super high 80, 89 times, 90 times forward earnings multiple for a long time. And then only after the Elon Trump victory in November 2024, the stock then soared into completely new levels, 150 times, 170. And now for a long time, the stock has been above 200 times forward earnings. So the reason why I recap all this stuff is you should not expect imminent doom, because even before the Elon Trump victory, the stock was already super expensive, and then the premium doubled even after that. And I'm not going to be the one who tells you this is the end, this is maximum. No, I don't know, because I'm a quantitative researcher. I just look at the numbers. I just tell you what I see in the numbers, and what I see in the numbers is quite crazy. But ultimately, and I keep telling these investors, um, what something is worth only depends on what someone else is willing to pay for it. It's not so the market tells you the price, whether you like it, whether you think this makes sense or not. Who cares? Ultimately, the market is always right because the market pays. So the way we approach investing is we think about, um, do we believe at time of our exit, is there someone who might be prepared to pay more for it than we would have to pay right now? This is fundamentally philosophically how we think about it. So if you were to buy Tesla today, what you should be doing is like go through this exercise, and you should be thinking, okay, in 12 months from now, um, do I believe that someone will buy from me Tesla at a price that is above the current share price? The current share price is $375. That's fundamentally a framework that you can apply. But anyways, I get too much on our attention again. So let's move on. I'm sorry, my voice is dropping. It's hurting, but let's move on. So next, let's look operating margin. So we just saw profitability is quite low, but let's express it in a relative terms. And a very important metric investors look at it is operating margin. It gives you a sense of the profitability in the business. Tesla's operating margin was 4.2% in the first quarter. That is very low for something that is a tech company at scale. And you can see that Tesla's profitability has been quite low for quite some time. So, for example, the average, not the average, the full year 2025 profitability was just 4.6%. And keep in mind, this operating margin reflects all the one-offs. So if you adjusted for it, this, as I said earlier, might almost get to a loss on the operating base, but it would be negative. So then let's move on. Next one is operating expense margin. We kind of covered this earlier. Operating expenses have been growing very quickly, driven by R&D expenses, but also by SG&A spend. And when you express these expenses as a percent of revenue, then you get these numbers. This is what I said earlier. Tesla's efficiency has been decreasing because the business was not growing, but spending was constantly growing. And Tesla's efficiency has been decreasing, as evidenced by a soaring expense margin. And you can see this in this chart. It's now 16.9% of revenue. Of course, the first quarter had several seasonal factors, so I expect this ratio to come down next quarter. But as things stand right now, when you then compare year over year, so next quarter will be 2Q 2026, of course, and I'd argue that we will not see a ratio similar to last year, which is 13.1. We'll likely see something much higher, which just demonstrates the trend of decreasing efficiency, unfortunately. Then when we I just jump slides, and we go to real quick non-operating items. So now we leave the underlying business, and now we talk about things that are not directly related to Tesla's business, and non-operating items were negative yet again. This is not that important, I would say, because it also includes the Bitcoin revaluation. There's a non-cash item. So first of all, in these non-operating items, there are three buckets. One is interest income, interest expense, and then there are other items. And interest income is simply what Tesla makes on the large cash pile it sits on. And there's an important income stream for Tesla. And then interest expense is not that much in Tesla's case. They have access to relatively cheap debt. And we'll look later at Tesla's debt levels. And then there's the other expense or income item. And this is where Tesla books currency effects, and it books Bitcoin. And I just quickly jump to it. So Bitcoin was again a negative impact because the value of Bitcoin dropped quarter over quarter. But this is not something investors really care about, because the Bitcoin valuation effect is a non-cash item. So this is not a needle move, it's not an explanation for what happened. But we can also see that in the other result, even if you exclude Bitcoin, there was still negative 313 million. And down here, I left a footnote that explains what happened. So basically what happened is Tesla pushed loans to subsidiaries to provide liquidity, and because of the changes in US dollar, there were losses to be recognized on these loans. This is also kind of let's call it a wash. This is also not a meaningful item. And the only reason why I talk about this is I want to show you this is not an item of concern. So because I want to show you the good, the bad, and the ugly. I talked a lot in this presentation about the bad and the ugly. So I also want to show you the good. So this item, even though it's 330 million negative, which is like 2/3 of operating income, this is all non-cash, so it's not important item. So forget about non-operating items this quarter. Not a big deal. Don't worry about it. So now we get to profit before tax. So now this is basically the result of everything we discussed. Profit before tax came in at 748 million. That's up nicely, 27%. But again, this was on a very low bar compared to last year, and again was inflated by a lot of positive one-off effects, slightly offset by some of the negative that we just discussed in non-operating expense. But in Tesla's case, we always have to look at earnings excluding massive share-based compensation, because, and I explained this on X, what people get fundamentally wrong about Tesla, and they have been for years, and I think this also gave them somewhat of false perception, is that I think for a long time people thought, oh, Tesla is this underdog and fights against all these big car companies, Toyota, General Motors, Ford, BMW, Mercedes, VW Group. And what they didn't realize, that was actually not true. Tesla was actually the big dog. And this might be very confusing to some people who listen to this right now. Okay, let me explain. Tesla very early on had a very large market cap. You can go back several years very quickly, even when Tesla was still a quite tiny automaker. It had a market cap that was larger than everyone else's, even Toyota's. And what this unlocked for Tesla was huge compensation packages. Elon could poach every talent because he could pay them very handsomely, because he could offer them stock, which then they could sell in the market later once the stock vested, for huge compensation. And the reason why Elon could do it was he had such a large market cap, because when you have like a $100 billion market cap compared to another automaker that has like 30 billion market cap, you have a huge advantage, because you can pay triple and your dilution is the same of the other guy. So you can outpay your competition, and ultimately it comes down to highly motivated, highly incentivized employees. So if you manage to generate a massive market cap, then you have a huge advantage. So that's why when people talk about or Elon tries to depress the market cap up until before SpaceX potentially buying Tesla. I would have always told you this is complete horse shit. Because of that reason, now we're in a slightly different constellation, but it's a topic for a different video. But the bottom line is Tesla was not the underdog for many years. It was actually the big dog because they could outpay everyone else, because this huge market cap allowed huge compensation packages without making big damage. And I will show you what I mean on, wait a second. On this slide. This slide is very important. I like to point out this scale starts at 3.4 million shares. So this is the number of shares outstanding, diluted, of course. And so because of the scale here, to make the changes more visible, it looks a lot more dramatic than it really is. So I would like to draw your attention to the second line here in percentages. You see very relatively small percentages. These are year-over-year growth numbers. So for example, in the first quarter of this year, Tesla's shares outstanding grew by only 0.5%. So there was very little shareholder dilution. And you can see when you look back for the last couple of years, there was rarely a quarter when there was a lot of dilution. And when you look at, it's an excellent example is, for example, Q1 2025. You can see, and also in Q2 2025, you can see here an increase of the dilution to 1.1%, and then it quickly dropped. But if you go back, this was the period when Tesla was super depressed market value. This is when Tesla incurred a lot higher dilution because the market, if you remember, the stock dropped during this period to under $200 per share. So this then spiked the dilution, but then Elon successfully reinflated the stock by announcing to leave Doge and announcing a lot of other stuff, and FSD improving and Optimus, yada yada yada. Then he reinflated the stock, and then the dilution dropped. Even though that's the kicker, even though he massively increased spending in R&D, etc. That is the correct. So the Tesla's huge market cap is a huge strategic advantage, and this is the only way where they can play with the big boys. And this is also why they could just wreak havoc in the auto industry, because nobody could compensate a key personnel like Tesla. And if you look at Tesla's executives, it's not a secret. Everyone in a senior position is like easily over 100 million who was at Tesla a few years ago, and that's why they have all this great talent, and why these people work so hard. And I can tell from firsthand experience. For example, I worked at Goldman, and I worked at Goldman at crazy times where we worked like for months over 100 hours per week, consistently 7 days a week, Saturdays, Sundays, yada yada yada. And the reason why did we do this? Because we were highly incentivized, because we earned a lot of money on huge bonuses, etc. That's why we work this hard. And Elon, of course, is smart. He does the same thing. He pays talent huge amounts, and that's why Tesla beats the competition. Elon is, of course, a highly capable manager and very smart, etc. But let's face it, you need to incentivize people, and the easiest way to do it is you pay them a lot, and this is what happens at Tesla a lot, and that's why the market cap is so important to the company. Okay, now we already skipped quite far ahead. Here, I just want to show you this slide. This slide shows you the share-based compensation. You can see this is going through the roof. In 2022, Tesla paid 1.6 billion in share-based compensation, and the year later it was 1.8 billion. Then in 2024, they did restructuring, they cut back a lot. It dropped to 1.3 billion. I'd like to also point out these prior numbers were inflated by recognition for Elon's comp package. And then in 2025, Tesla started to pay a lot more again in share-based compensation, and now it starts to going through the roof again. And because Tesla started in Q4 2025 accruing for Elon's new compensation package. So what you should expect is that this share-based compensation keeps rising, and the effect is the following. The GAAP numbers will, even if Tesla's business performance improves significantly, because then the achievement of Elon's comp milestone will become more likely. Then Tesla keeps recognizing more and more its comp package, and because Elon's comp package is so large, these recognitions will be very large, and then basically we end up in a situation like a couple of years ago. When you go back to those numbers, and I will cover this in a future presentation, you can see that the gap profitability will be mostly wiped out by these large recognitions for Elon, and something similar will happen. But the good news is, I know this sounds very ugly, but the good news is these share-based compensation expenses, they're non-cash, because Tesla just issues shares to Elon and executives, so there is no cash outflow. And that's why when you then look to the adjusted numbers, you add back these amounts. And this is why now we look at adjusted shareholders net income as disclosed by Tesla. You can see now that the company brought in almost 1.5 billion in the first quarter. And now I jump back to the other slide. This is the gap shareholders net income. This is only, let's use round numbers, 500 million. This is the 477 that you see down here. So this 500 million compares with the 1.5 billion that we look at here. And the delta is mostly this non-cash share-based compensation. And investors, because the market cap is so large, this large share-based compensation doesn't make a big impact in terms of dilution. So investors look to the adjusted number. So the relevant number for Tesla is this one, the adjusted shareholders net income, and not this one, the gap number, the shareholders. This looks awful, of course, but the adjusted number looks a lot better. And we tested this also a lot in our methodology, back tested this a lot, and the implied multiple that you get on adjusted shareholders net income is much more stable than the one on GAAP net income. Of course, experienced investors will say, yeah, of course, AJ, this is almost always the case. I just want to confirm this. We don't like to assume things. We always like to check, and we did check in Tesla. And in Tesla's case, it's crystal clear. If you want to run a multiple, you should use adjusted shareholders net income. So the bottom line is this number is a lot better, but keep in mind Tesla did not adjust for all these one-off items we explained earlier. So on this adjusted basis, Tesla would also be, let's call it what it is, barely profitable, but they would be profitable. But I estimate the 1 billion that I mentioned earlier of adjustments, you have to then apply what's called the tax shield. So you have to account for the effects of taxation. And basically, the correct way of looking at this, if you assume a tax shield of 20%, you would subtract about 800 million from the 1 billion of gross one-offs. And so this would leave us with, let's call it 650 million. So that would be the adjusted, this would be the adjusted shares net income. Anyways, so the bottom line is, if you adjust properly for everything, the year-over-year Tesla's earnings didn't move at all. That is the key takeaway. Okay, so now we are done with the income statement. I know this was a lot, but the income statement is only one dimension. Now we need to look to I talked about this on the Hardcore channel. In my view, there were three drivers that caused share price pressure. Number one is what all the stuff we just discussed. So the earnings were just, the underlying, there was just a massive miss in the numbers. So there was point one. Point two is what we're about to discuss. And this is about Tesla's capex. And then point three is what management said on the call about certain other topics. So these are the three, let's call it pillars of the share price pressure on this after this call. And now let's talk about the second one. Let's talk about the capex. Let me just jump to, okay. So when it's about capex, we first need a little bit of background. So the income statement just shows you, let's call it a smooth view of the actual reality in the business. A much more useful statement is actually the cash flow statement, but the cash flow statement is not as user-friendly as the income statement. But the cash flow statement tells you actually a lot more what's going on. So in the cash flow statement, a key metric is the operating cash flow. The operating cash flow is basically telling you, okay, if you ignore investing activity, if you ignore finance activity, how much cash did we take in less how much cash we paid out. Basically, that's what it is. And in Tesla's case, that was stable. The number came in at 3.9 billion. That was actually up a little bit quarter over quarter to 3.8 billion. And this will probably surprise a lot of people because Tesla overproduced 50,000 vehicles in Q1. So production was 50,000 vehicles higher than what was delivered, and this creates a capital consumption, i.e. lowers operating cash flow. So how did they manage still to increase operating cash flow? And to show you exactly what happened is I included this, it's called a cash flow bridge or operating cash flow bridge. It shows you how you go from Q4 cash flow, which is 3.8 billion, which is the number right here, to the 3.9 billion delivered in Q1, which is the number right over here. So you see all the steps. So if you add up all these steps, you go from the 3.8 to 3.9, and you can visually, you can immediately see, okay, what are the key drivers? The negative element that everybody had on the radar is the inventory. As I just said, 50,000 vehicle higher production consumed 2 billion in capital. So what was negative. But then there were a bunch of offsetting items, and the biggest of which was what's called prepaid expenses and other assets. And down here in the footnote, I explained what that is. There's a bunch of things included, and what exactly was the main driver within this large bucket, we don't know. But just read out the footnote to you so you get a little bit of a sense. Of prepaid expenses comprise mostly supplier prepayments. So prepayments for battery pack deliveries, for chips, raw materials, and AI hardware, data centers. So because these are large purchases, in many cases there's some prepayments to be made. In Tesla's case, in Q1, Tesla reduced that massively, and that then created a significant cash release in essence. And then the other big item was Tesla took in a significant deferred revenue that was not realized in the income statement. There was another positive effect. And I will not go through everything, but the bottom line is the way you should think about these items is which items are, let's call it perpetual in nature, or it could be perpetual in nature, and which are discontinuous in nature. And a good example is accounts receivables. Accounts receivable is how much customers owe Tesla. And accounts receivables, you can see here, was a positive. That means the amount of accounts receivables, or the amounts customers owe Tesla, reduced. But of course, this number cannot keep reducing infinitely, because at some point all customers will have paid all their bills. And that's why when you see in an operating cash flow accounts receivable as a positive, this is considered a very low quality item, because it's discontinuous. Because at some point in a few quarters, for example, if Tesla kept running down accounts receivables, they would run out of accounts receivables, it would become zero, and that driver would be gone forever. And that's why this is a discontinuous positive driver. So I will not spend more time on this slide. The bottom line is, and I wrote down here the key takeaway, and I just read out loud to you. So the Q1 operating cash flow was held up by favorable receivables and deferred revenue timing, rather than underlying operating strengths. The inventory swing is the line worth watching next quarter. So next quarter, and that's a positive, because Tesla is now excess inventory. Tesla's inventory days are now at 27 days, which is actually a long-term high. It means if Tesla stopped making cars, they could sell for 27 days without running out of inventory. And the bottom line is, in the next quarter, Tesla will not have this inventory headwind, so this will help the cash flow. But the problem is, and now we get to capex. That was the second element what created share price pressure. So this is Tesla's capital capex development, and the company invested just under 2.5 billion in the first quarter. And you can see this is broadly in line with the last couple of quarters, but we knew this before. Tesla already told us in January that they would expect capex to be quote in excess of $20 billion. And then this week they told us for 2026 capex would be over 25 billion. But here's the problem. They only spent 2.5 billion in the first quarter, and now they want to spend over 25 billion for the full year. That means the math is very simple. You say, let's assume 25 billion. So what you do is you subtract 2.5 billion from 25 billion. That leaves you with 22.5 billion. That's the amount Tesla wants to spend over the next 3 quarters. So if you now just imagine this chart, how this is going to look like at the end of this year. So Tesla has to spend over 7 billion per quarter in the remaining 3 quarters of this year to get to this level. And here's the problem. Now we go back to operating cash flow, because operating cash flow is financing, or is one source of financing. In 2025, Tesla generated for the full year 14.7 billion operating cash flow over the last 12 months. The last 12 months, it generated 16.5 billion in operating cash flow. So let's assume this is the run rate for 2026, which is probably not too far off from the reality, because I don't see where Tesla would get more cash. So Tesla would effectively almost burn about 10 billion in capital in 2010, and all this negative free cash flow would be recognized over the next 3 quarters. And here's the other problem. Tesla had 1.4 billion in positive free cash flow. So that means if the net sum for the year is like a cash burn for 10 billion, that means over the next 3 quarters, Tesla will be burning more than 10 billion, will be 11.4 billion. So big picture, and I know this is probably somewhat confusing to some people. The big picture is you will see deeply negative quarters from here on out for at least the rest of the year, and I expect this negative free cash flow will likely continue until into 2027. That's the unfortunate reality, and that was the other element that caused pressure on the stock, because investors know, okay, Tesla is now burning cash again, and this is actually a change in corporate strategy. Elon said many times that they try to invest into the future, but they try to manage for cash flow positivity. All this has now gone out of the door, and I think this provides more circumstantial evidence to what I was saying earlier. This does not look like a super confident company. This is a company who tries to vertically integrate everything to create some competitive advantage by throwing money at the problem, building everything in-house, yada, yada. This may pay off down the road, but it's typically Elon fashion, extremely high risk taking, and it may work out or may not work out. But the problem is, what works out for Elon may not work out for Tesla shareholders. And now I have to say something very ugly, but it's unfortunately true. If you look at the estimates of Elon's net worth, he basically have 5x his net worth over the last 5 years. And now look at how the net worth has changed of someone who was all in Tesla 5 years ago. The answer is not that much. He might even be down if you were unlucky. So Elon did exceptionally well for himself, his family, and all his associates. But but people, the fan base who invested in his only public company right now, Tesla, they did not that well. And the people who invest in his private companies who did exceptionally well, these are mostly high net worth individuals or people who have access to funds who can then via vehicle invest in these private companies. So a large part of the global fan base was left behind in a sense. And this is a feature which I don't like very much about the Tesla community. There are some elements, they always pump everything, but they never look at the collateral damage that has been done to some people. And so that's not that great. But Tesla community is very large. There are a lot of great people in the community. So that's just something worth pointing out. And again, a lot of people consider me a hater of Tesla or Elon. This is not the case. I'm a huge fan of the company. I invested in the company in 2013 and held the stock up until Elon started talking about selling Tesla to acquire Twitter. That was just something I could not ignore. And this is the day when I sold down my position and started trading the stock and did not consider permanent hold anymore, as I had done in many prior years to that point. And I recommend everyone who listens to this should try to move away from a permanent hold, because everyone, I said this many times on X, everyone is trading Tesla. Elon is trading Tesla. Elon sold a lot more at Tesla than was necessary for a Twitter acquisition. I spent a lot of time at the time working out these numbers, whether this was really necessary to cover risk. It was not, but it's a different rabbit hole. Elon's brother sold many times Tesla stock. And other key executives, board members are known for that. And I know famous Tesla influencer pumpers, in some cases, they publicly admitted selling Tesla stock. So virtually everyone I look at that is positive and super bullish about the stock, everybody is selling a stock. Casey Wood is famous for constantly selling stock, and Ron Barron sold from his fund. Yes, he said he kept privately Tesla stock, but the bottom line, everyone is selling, trading this stock. So you really have to ask yourself, is it really necessary that you hold the bag for Elon and his associates and all the investors? No, he got enough money. He will be fine without your money. So I recommend take a more pragmatic approach. I know this is highly inflammatory what I just said, but I talked to a lot of people who lost a lot of money over the years, and it's just very sad to watch. So anyways, so this was the second pillar, which is a problem. So stock will be highly cash burning. And now we get to the last part. Here, just a couple of slides. I'm not going to get into. This is an interesting slide about FSD, deferred revenue, but I just flip through it. I will not talk to it. So everyone who watches this video can pause if they want to and read through the slides. Some of them are a little bit complicated. And the reason why I just show you these slides is, and this is only the tip of the iceberg of what we do. Just to be clear, we go into an extreme level of detail to uncover the truth, and we only care about the truth. We are not uber bulls, uber bears. No, we just want to make money off the stock, and it has nothing to do with our sentiment for the stock. We are huge fans of Elon and the company, but being a huge fan of a company and what they want to achieve should be divorced from the share price. You should be, it's at the end of the day, it's very simple. You should buy when the stock is attractive, when it's cheap, and you should sell when it's unattractive and it's expensive. That's it. And it has nothing to do with your feelings for the company or management. So with that out of the way, let's talk about the last part. And I just put you some quotes from Elon over the time, but there would be a lot more stuff and maybe even more relevant stuff, but I didn't really have time to compile all these exact quotes. So now we come to the third pillar that created downward pressure, and that was about what management said. And the biggest problem is that and I will get a lot of hate for that too, but at this point it probably doesn't matter anyway. So when you listen very carefully to how Elon talked and how he phrased it, when there was a question about hardware 5 in particular, and when he was asked about what can be achieved with hardware 4, he did not say robotaxi. He phrased it in a way, and let me see, is this here in this quote? Uh, um, um, I know it's not okay. It's not here in this. Oh, sorry, it's not in here in this quote. But there was a point where he talked about he believes that hardware 4 is capable of delivering much better safety levels than human drivers. So he went in his speech at great lengths to avoid any ride-hailing autonomy implications, um, because what he said was basically what we already see. The system is already a lot safer than humans. But to be safer than humans doesn't mean it can be robotaxi. It can be fully autonomous. These are two different things. And so when I listened to it and I thought about this a lot, and the tone and everything and the setup, I came away, and unfortunately, I will have to reflect this in my forecast. It sounded to me, we will not see a fully autonomous, easily scalable cybercab on hardware 4. And the way I just phrased it, I applied basically exactly what Elon did. The way I phrased it, there are a lot of caveats. So what I just said is autonomy can drive by itself and easily scalable. That is a big caveat. And easily scalable means in a new city where I have not been testing for months for safety, for odd intersections and stuff like that, easily scalable means I can just send the car and cover new area. That was the promise from day one, since by now almost 10 years. This is what Elon was always promising. And this is also what he ridiculed in other players like Waymo and another company. He always ridiculed them. Oh, this is not scalable, blah, blah, blah. You need HD maps. But we are, and let's be brutally honest, we are right now in a situation where Tesla is like in a similar situation. The system is very, very good, but it's simply not good enough to just roll it out into a new area. So what Tesla has to do now is they have to test everything to make sure there are no accidents. Of course, and God forbid, nobody wants an accident, because if and I don't even want to talk about it, but imagine there's somebody who got over by a cyber cab on camera. That would be a catastrophe. But of course, Tesla is very smart. They will make sure this doesn't happen. So they're very careful. So they're doing the right thing. But the problem is, this created an extremely slow rollout, because if you remember, the Tesla launched in June 2025, and we're not soon. It's going to be a year, and there are almost no fully autonomous vehicles at this point. There's still some human in the loop. There's some monitoring involved. That is a big problem, because we effectively ended up in a situation which is very similar to these other systems that were ridiculed for you're not scalable because you're using all these HD maps and this all other stuff. But now Tesla, with its very sophisticated approach, is similarly slowly scaling. And my takeaway is, when I look at how management sounded on the call, I believe this easily scalable solution is only unlocked by a lot more compute, and that compute only comes with hardware 5. And I think there were also some other breadcrumbs which indicated that Elon was also talking about how there will be like an upgrade with more memory, etc. I think these are all attempts to expedite the performance level of the system, because I think what they realized is hardware 4 is really good, but it's not a safe enough bet to bet the farm on being able to scale out large enough scale. I know it's very controversial, and of course I have to do some speculation here, and I don't want to speculate. So everything I said was based on how I read Elon's sentiment on the call and how he phrased it. And this is based on my experience on having listened to every single Elon Tesla earnings call since IPO. So I have I think a lot of experience in how he works with investors, and I can tell you he's extremely skilled in the way he phrases his words, and with that experience, this is where I come out. And at this point, I stop here and hand the word back to Jacob.
Thank you, AJ. I know that's tough to hear, maybe for lots of people in my audience. I know it's a giant red pill, perhaps, but I wish I took an excerpt from the earnings call. I think when somebody asked Elon for a timeline on robotaxi, and there's maybe 10 seconds of silence, and you pointed out that you've never heard a silence like that from Elon.
Yeah. The thing is that there. Look, the thing is, for example, something I like to do, tell you a little anecdote. In school, a favorite topic of mine was what's called speech analysis, and you can look this up or prompt Grok if you don't know what it is. And what you do is you take an article. It can also be a speech, audio, whatever, and you analyze every single word, why the word is used, why it's in this position and not in that position, why it's repeated, things like that, and you try to figure out what's the true intention of the author. And you can apply this approach also to earnings calls, and by applying this methodology to not only Tesla and Elon, but also all the other companies we analyze, and it's a lot. You can see these patterns, and by applying all this experience, I like to think I built over the decades. I can see clearly what he's saying, and what he's saying effectively between the lines suggests hardware 4 may deliver what we all hope for, but there is massive risk and it may not ever get there, and that is the problem. But this is ultimately what it boils down to. So the question is, okay, so what's going to happen with Cybercab? This is really what everybody wants to know. Nobody really cares about hardware 4, 5, 4.1, whatever. What everybody wants to know, okay, how many cars by when? That's ultimate, because that is driving the economics, that's driving the share price. My view is that we will see Cybercab launching. We will also see meaningful numbers of Cybercab launching. But it will be effectively what we saw almost 12 months since the June 2025 launch. It will launch, and there will be a lot more fully autonomous vehicles, but they will be concentrated in these safe zones, in these areas that Tesla knows. Okay, the system works. We trained on all the sketchy intersections and corners, and these areas that we don't know, we fence off. The Cybercab will never be able to even go there. This is how they're going to do it. And so you will see the numbers go up quite nicely. We will quickly end up in the hundreds, 500, 1,000, 5,000 Cybercabs and more. And it will look like, oh, this is like great progress. But here's the crux. Even, and I said this on X in the HT channel, even if we get to 10 or 15,000 Cybercabs by the end of December of this year, I know the Uber bulls will sell this as a huge achievement, and look, Tesla delivered. Unfortunately, the economic reality is very different. If we only have 10 or 15,000 Cybercabs by the end of this year, it would be a very slow ramp, and would be far below our expectations. Not only us, it's not, you could say, oh yeah, AJ, maybe you had excessive expectation. No, because what we did is we modeled the Cybercab ramp as a sigmoidal curve, so slow start and then ramping up, because Elon was always hyping you should expect a very slow start and then it's kicking into gear and you have more production. This is what we modeled, and if we see the start of Cybercab production, it has officially already started. So if we don't, and keep in mind, 10, 15,000 vehicles at the end of the year is not the the production rate of Cybercab at the end of the year. No, it's all the Cybercabs that are being produced from now on already, all the way to the end of the year, because that would be the fleet size. And if we only see 10, 15, that would be a huge disappointment. And again, you will be told by these Uber Bull channels, oh, huge, blah, blah, blah. But the point is, this would just confirm what I unfortunately have to speculate. The system is not good enough, and that's why Tesla will have to use this super cautious approach, because an accident is simply not they can't risk it, because the media think about it. Imagine someone is run over by a Cybercab a few months after launch. The media would have a field day with that. You would see it 24/7 all day long. They would show, and God forbid if there was video of that accident, incredible. So that would be the most watched video probably on the planet that week. But anyways, so let's not talk about these horror scenarios. So Tesla, of course, is smart. They know all of that, and it's why they will be super safe. And that's why I believe they will take it very slow, and then we will have this disappointment setting in, that production is very slow, because what we just talked about, then more and more people will realize, and that just creates a headwind. And yeah, so anyways, I don't want to sound too negative, but the problem is, when I look at all the data, all the evidence, the way management behaved, talked about it, I can't be very optimistic right now. That is the problem.
And I want to make one more point, because I cover everything Elon said, and we were talking about today why and how he says things. And you made that point where he's very, very good at exactly picking the right words to keep that multiple high. And one of those things on the call was framing this, let's call it a delay in showcasing Optimus 3, as him not wanting to reveal to competitors the frame by frame analysis. What is
Yeah.
Elon really saying when he says that?
Yeah. Okay. So yeah, that's another inflammatory point. But as I said earlier, at this point, it probably doesn't matter. We just
No.
talk about it. So yeah. So Elon used that one before, and he was, I have to give him credit. He's incredibly clever how he plays these things. So of course, people have been waiting for months to see more from Optimus, right? And Elon made it sound on the call, yeah, we just don't want to show it because people just copy everything we do, and that's why it makes sense to just release it just prior to wide release. And the reality is a bit different. I can't go into detail, but our sources, etc., show us the situation is not quite like that. The team is actually in a high alert stage. They know that there's competition growing very quickly, and they know they don't have a comfortable lead, and that pressure is in the team. And so the reality is, look, if you remember, a couple of months ago there was the Tron movie release, and Elon, clever as he is, or his marketing team, they sent an Optimus to the premiere of the movie, and then Optimus was going through some sequences. But then when you look closely, and people analyzed it, what was presented was actually not that impressive in terms of movement. Of course, then people try to talk it away. Yeah, but it's optimized for lowest cost. And the other companies, they just build expensive bots that never work. And there was a tricky part. And then there was this other sequence where the Optimus did this kung fu fighting. Of course, this was all pre-programmed, and the bot could have done this kung fu fight without the human in the scene. So this looked great, but ultimately was also not like ahead of what we see from some players in China. And then there was this post, and a lot of people, I think, didn't notice. I saw it, and I posted it, and there was a video, I think, from Figure, and where the bot did something, and then Elon asked, yeah, like, is this but is it teleoperated? So is a human navigating the bot, or does the bot do it somehow by itself? And by by asking, and it turned out Figure later, so engineers from Figure confirmed this was not teleoperated. And by Elon asking, oh, is this not teleoperated? He actually reveals a lot of information. Imagine at that point, Optimus would do all kinds of stuff by itself, no teleoperator in the loop. Then Elon would not even talk about it because, yeah, we've been doing this for months, right? That would be his attitude. But by looking at this and wait a second, oh, is this but this is teleoperated. He kind of reveals his surprise, or he was kind of taken off guard. This is how I read it, and based on all the intel we gathered, one cannot make the case that Tesla is so far ahead, and the Optimus they will present will be so spectacular. I think what's going to happen is, and this is more relevant for investors. I'm quite sure, because Tesla pumps huge amounts of money into Optimus, and they started, of course, among the first, and what they will present will look quite competitive, and it might be very competitive. And here you can, as an investor, rely on the community. The Uber bulls will present whatever is presented as the best thing. So this is something you can bet on as the investor. So even if the Optimus is not have not the best, not the most efficient body, they will present it as such. They will always tell you it's the cheapest spot and therefore much more competitive than other products. And then if Optimus Brain is not super great, they will talk down other competitors. So we as investors, we can rely on that influencer industry to protect us in a way. So this is like the meta perspective I always keep talking about. As an investor, you need to look, you need to look at the, you can't be a chess figure. You need to look at the playing field, like from a helicopter perspective, to see how the chess pieces are moving, and I call this a meta perspective, how the circus is playing, and not be part of the circus. And so my view is that paradoxically, even though I think it's going to be highly competitive, and it's not going to be a Model Y moment where Tesla was able to build a revolutionary vehicle for many years and then presented, and everybody was caught off guard and gave Tesla a huge advantage. No, Tesla is now racing with a bunch of other companies and with much more agile companies. So that's a completely different nature of competition. So I think the Uber bulls will protect us somewhat, at least from this negative outcry, should it happen. So this is just, I know this sounds horrible, but some of it will be offset, because people will say, oh, but the US market is tariffed off. All these advanced Chinese humanoids, cheap humanoids, they can't come into US. This is partially true, partially not. But then there's also homegrown competition, and anyways, and then people, when they run out of arguments, they will say, oh, but it's a huge market. Yeah, sure, but ultimately, it's not the point, because if you have to sell something at low margins because competition is fierce, then you still don't make money. We see this, for example, in the smartphone world. There's basically only Apple who makes really great money with smartphone, and everybody else not so much. And I invented this example of Apple. Apple introduced the iPhone in 2007, and it caught everybody by surprise. Nobody was prepared for a $600 phone with all these features, with all these hardware, so expensive. And then everybody had to quickly scramble to make their own smartphone, and they were lucky, Google providing Android, and this is how they could then deliver something years later that was somewhat competitive. But then Apple had already established this huge lead, which they kept to this day. And this huge lead then drove the largest gross profit generation ever in the human history of any product. And now we come to the example I've invented, and I said, okay, what if Apple had presented the iPhone in 2007? Like Tesla started talking about Optimus many years ago and not delivered the iPhone right there in 2007, but delays in software development, touchscreen design, blah, 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 would have delayed the iPhone launch until 5 years later, 2012. And in the interim, let's assume Nokia, Ericsson, Samsung, all the other electronics would have also developed for 5 years an iPhone or a smartphone. And all of these companies would have then pressed into the market around 2012 or maybe a year later. I argue Apple would never have generated this huge gross profit, this huge gross profit capture. Because when you look at the smartphone market, you should not look, not even at revenue. You should be looking at total gross profit. And what you realize is Apple is taking home more than 50%. And so that's like insane. And if in my argument is, and I argue, if Apple had launched, if this hypothetical scenario that I just described had played out, Apple would have not even captured 10% of what it did capture. And I think because Tesla couldn't make FSD work to the level it promised many years ago, I think already 90% of that huge gross profit potential is gone. The 10% is still on the table, is still a very large upside potential. And that's why I think Elon had to move to the next big carrot, because for many years the big carrot was autonomy. But then I think he realized, look, he's extremely smart, extremely strategic thinker. He knew this is not going to help us sustain the market cap. We need the next one. And then he came up with the Optimus product, which was brilliant move, incredible move. And that then kept the story going despite these dark times, and that kept people still invested in the stock, even though the auto business was going downhill in terms of margins, etc. And a lot of other things happened. So I think I kind of lost the plot here. I think I've started rambling too much here, but the bottom line is there were already 3 factors on this call: earnings miss, negative cash flow outlook, and autonomy appears to be not scaling rapidly this year. This created a pressure in the stock.
Yeah, so I opened the video saying, do you need to have FOMO with Tesla still? And I think based on those 3 pillars, you don't need to have FOMO yet. And so the hardest thing and the most inflammatory thing about hearing that for Tesla investors is they don't know where else to look. And AJ, through the hardcore channel and through his AJ investment research channel, provides analysis on companies at the level of detail that you witnessed in this video. And through consuming videos like this on other companies, I've been very fortunate to come to learn about other companies. And the more companies you cover, the more opportunities that you'll spot. So the money that I once had invested in Tesla, I'm now happily deploying elsewhere with confidence. And you might be wondering what this corridor is. This is, I guess, what we could call a makeshift cockpit before we get into it. But you're constantly evaluating companies relative to themselves and how they are attractive. They are relative to themselves. And AJ, I'm going to save your voice to quickly try to explain this corridor to people. This is Tesla's corridor, and you can adjust how the corridor is constructed. Basically, right now it's analyzing the last 90 days sentiment, and it takes the median sentiment over the last 90 days and multiplies it by the historical numbers as well as his forecast. So back here, Tesla was not as expensive as it is today. So that's why the corridor looks like it should have been much higher, because it's taking the last 90 days and applying it to the entire history. But what's going to happen based on this earnings call, because AJ has not updated his forecast yet based on these delays. And AJ was basically forecasting what management was telling us and what the market was expecting so that we could try to get an accurate forecast corridor. But now that these delays are happening, that increase in share price is going to get moved into the future. It's going to get moved farther to the right because of these delays that's happening. So once AJ is done, hopefully he comes back onto the channel and shows us his forecast. And so I could do a longer explanation on the share price corridor if I started talking about how you can change the sentiment to evaluate it. You could evaluate also on a 1-year sentiment level. But I just wanted to show you guys that there are tools out there from AJ to learn about other companies so that you're not only studying Tesla.
Yeah, so on that point, I included actually because I anticipated something like this. So this slide is literally a screenshot from our research portal. This shows you a bunch of companies. I just name them real quick: Alphabet, Amazon, AMD, Apple, Broadcom, EOS, Infineon, Intel, Meta, Micron, Microsoft, Nvidia, Oracle, Palantir, Rivian, Rocket Lab, Samsung, SK Hynix, Tesla, of course, TSMC, Uber, Xiaomi, and Xpeng. These are the companies under our current coverage. And we build tools for all companies currently highlighted in red. And for the remainder, we expect the tools to bring online soon. And in our investment approach, what we do is, as Jacob already said, we don't use classical valuation methods the market or like I, for example, I'm classically trained. I was an investment banker. I went through standard analyst training at Goldman Sachs, so I learned from the bottom up everything, and so I know like how investors would approach valuation. I even sat on valuation committees, drafted fairness opinions, which is like the highest standard of valuation in financial markets, because the bank who issues a fairness opinion has liability. So anyways, I'm just telling you these things, not to talk about myself, but to make the point. I know a lot about these things. I know how investors traditionally value stocks, or companies in M&A, etc. But the bottom line is, this stuff doesn't work for Tesla and doesn't work for a lot of other companies. So what works much, because what traditionally investors do, they compare companies. They use valuation multiples. They use DCF, discounted cash flow models, or DDM models, a dividend discount model, and all these different things. And I have applied all these things to all kinds of companies. So I have really in-depth knowledge. But the problem is, in the stock market, something like TSLA, you cannot capture with these things. So what I kind of invented is the wrong word, but derived was that you have to capture the idiosyncratic sentiment in a company. That's very important, and that can be completely independent from the industry, from the sector, or even from companies that are considered closest peers. So in Tesla's case, that approach then produces this corridor that Jacob was talking about. And when you look closely at the corridor, and once you understand how it works, you realize it's a very powerful tool to both signal excellent exit points and also excellent accumulation points. So when you go back into the stock, so this is how we do it. We buy the stock when it seems going outside the implied range, and recently it actually did again indicate the low correctly, and it recently also indicated the high in December correctly. But there's one big problem, and I talked about this plenty since December. There's one giant caveat. The problem is, we have not yet talked about the elephant in the room, Jacob, and I'm not sure if we want to talk about it on this video, and it's SpaceX. I'm not sure. Should I carry on with SpaceX?
I don't think so. I think we should save it for another video, but yeah, you would call it uninvestable right now due to the SpaceX IPO.
Yeah, the SpaceX is a big problem for us. But I think people who follow us on X, they probably saw our views on that point. Yeah, and that's why just would like to make one final point, and is the share price corridor that Jacob presented cannot capture a unique corporate event like SpaceX IPO. I just want to make this very, very clear. So this corridor has been amazingly accurate in the past, but in the past there was no second Elon stock in the market.
Yeah. Yeah. So, yeah, I know that'll be a shocker or whatever this video maybe, because I don't often express my opinions on the company, and I just told you guys what Elon said. But AJ has opened my eyes and many others to other investment opportunities, and that can help you get rid of your FOMO. And this is where you can find AJ's accounts for just $10 a month subscription. On this account, you'll get a weekly report showing all the corridors and what looks most attractive. But on this account, you'll get much more in-depth commentary on a day-to-day basis, and as well as the videos much faster. And I have many stories I could tell you about some trades that I've made and also been saved from. I remember when Jeff Lutz was talking up EOS. Oh, my headphones just got weird. I started a position, but then when AJ reported on EOS, he highlighted some red flags, and I decided to get out on their next earnings report. Some of those red flags came to light, and the stock dropped 40%, and AJ saved me from that one. So that's just one story. But this is where you guys can find AJ, and I hope we have him back once he completes his Tesla forecast with the updated delays. AJ, unless there's anything else you want to say, thank you so much for coming on.
Thank you very much for having me. It was fun.
All right. Thanks, AJ.